Welcome to Investors Insights, where today's topic is market overvalued, ? Not so fast. So a lot going on this week in the market. Last week, the market was volatile to close the week on some trade war conversation. And before I get to the importance of dividends and an update on stock dividends, Ty, there's a lot of conversation in the market right now about being overvalued, that we're in a bubble because of AI. And just talk about that for a minute to our audience here.
Yeah, I know I've, had conversations with clients and prospects in the past few weeks about, kind of our outlook on the market as is typical for this time of year. You're kind of wrapping up the year, going into the new year, and a lot of concerns on valuation, of course. And then, we got kind of a nasty little pullback on Friday, which was, just a temporary kind of thing, it looks like. But some interesting data, 91% of fund managers, according to this global fund manager survey, believe that U.S. stocks are overvalued, which is very interesting. Then down here, you see that they believe that emerging markets are undervalued. Typically, this is not when you have a bubble. Typically, people are a lot more, I wouldn't say on the fence. People don't think things are overvalued at the time. And then you look back on it, and that's kind of when you have more of these nasty pullbacks. When everyone's on guard for something, the thing typically doesn't happen. It's when you're not expecting something is when that happens. So interesting survey, as you can see the results here in this chart to see. But that also kind of got me thinking about valuation, not just from, a sentiment perspective, but what has changed really. We talk about how multiple expansion has happened in the market. Oh, the market's trading at this times PE, which is much higher than it was before. What has kind of changed? This is an interesting chart. So if you look back in kind of like the 1970s, tech only made up about 10% of the index, whereas tech now is routinely 25% or more of the overall S&P. And so why does that matter? Tech typically has faster growing companies, typically has higher multiple companies that you're paying out for in future earning years. Whereas things like staples and energy or utilities, those have all kind of decreased in their market share from around 15% of the index to much lower levels. And so as you're getting this dynamic of tech companies continue to grow, take up more of the index, maybe consumer staples which typically trade at much lower multiples because you kind of know what you're getting. Everyone's always buying toothpaste, toilet paper. It's been an interesting dynamic when you get that shift, and can kind of explain why maybe you do see elevated multiples for longer periods of time in today's day and age, as opposed to before. It's just kind of a natural, progression, honestly. But one thing that we are watching to always check the valuation of the market is, and this is one of the most important relationships we keep an eye on, is consumer discretionary relative to staples. And that means we're kind of comparing where consumer discretionary is and where consumer staples are. You always want consumer discretionary in a bull market to be rising and continue to rise past staples, because again, staples are stuff that you're going to buy whether we're in a recession or in a bull market. Discretionary is going to be items that you're buying when you have more money, in excess of money, when things are good. So you always want to see this relationship stay strong. As you can tell, it's been strong for the last couple of years. Of course, we've had a good run. The relationship kind of pulled back a little bit Friday, and it's something we certainly want to keep an eye on. But we always want to make sure that discretionary is rising faster than staples and over that 50 and 200-day moving average. So that's what we're watching to determine, some valuation metrics.
Yeah, thanks, Ty. I mean, there's so many different opinions on if the market's overvalued, undervalued, fairly valued. But that's why we partner with the top research firms in the country in helping us build our investment strategies. And so I want to give an update on stock dividends now. So while dividends continue to be one of the most efficient ways for companies to return capital to shareholders, they also contribute meaningfully to overall returns. In fact, for many investors, dividend payments have become an ordinary and expected benefit of equity ownership. And as you can see in this chart, of the 503 companies in the S&P 500 index, 407 reported distributing a cash dividend to their equity owners as of October 7th of this year. You can see the different yields by sector in this chart here, and the impact of these distributions on the investment landscape has really been nothing short of extraordinary, with dividends accounting for 36.7% of total return of the index between September 28, 1928 and September 30th of this year. Again, dividends account for 36.7% of total return. So dividends are obviously important. And then obviously many investors view changes in dividend distributions as an indication of financial strength or weakness in the underlying individual company. And just 7 dividend cuts and 1 suspension have been announced year to date through the end of September. For comparison, 11 dividends were cut and 2 were suspended over the same period last year. That tells us that corporate America is healthy. Additionally, dividends can act as a potent inflation hedge. And so far, inflation, as we talk about all the time, is measured by the Consumer Price Index, increased by 35.9% over the 10-year period ending in August of 2025. Total dividends paid by the index stocks increased by a staggering 80.9 over that same time period. So we're watching market valuations carefully, and we like what we're seeing from corporate America in the form of dividends. So thanks for watching. There's a lot of information out there. Please call us, follow us on social media. We love to hear from you. Thanks for watching.